get started, hey everybody, thanks for joining us. I'm Chris, co-founder of Sterling Rhino Capital, and I'm also joined by the other co-founder, Paul Wilcox. He's our COO. And then we've got Alfonso Saverino. He is our Director of Finance and Accounting at Sterling Rhino Capital. And today we want to discuss all the many advantages of investing in multifamily real estate as it relates to taxes. And there's no person more qualified than Al, as he is a certified Tom Wheelwright wealthability advisor and also a proud graduate of Penn State. So congratulations, Alfonso. Thank you. Hey, everybody, before we get started, I want to ask, if you don't mind, how you heard about us. Just give us a little message in the chat. Did you hear about us in an email blast? Did you hear about us on Facebook, YouTube? What brought you here? Again, if you're driving, don't worry about chatting. But if you get a chance, please type in the chat box and just tell us how you came about this webinar. Let's see, email, cool, email. All right. Probably a lot of newsletter invites. That's how we usually bring a lot of our audience in. So email blast, cool, right on, thanks. Social, cool, social, awesome. All right, well, we will get started. If you guys have any questions, please feel free to throw them in the chat. We will review all the questions at the end and give Al an opportunity to answer those questions. So this is your opportunity to talk to a high-level certified CPA who is in the multifamily space and also a team member of Sterling Rhino Capital. So please don't let that go to waste and type those questions in. All right, Al, so without further ado, Al will take it away and dive into this wonderful multifamily investment space.
Thank you, Chris. Thank you, Paul, for giving me some platform today to talk about taxes. And just a little bit about myself. I'm a CPA. I've been doing this for over 10 years now. Been managing real estate passively. And most of our client base at Edwards Ingram, my firm, has real estate somehow related into their life, whether they're doing single family homes, they're syndicating, they're in syndications, they're managing, commercial real estate themselves. We routinely advise real estate investors of all walks of life. We actually, Edwards Ingram, my firm, we are the leading provider for Tom Wheelwright, and we are servicing pretty much all of his clients at this moment. They all come to us. All the clients that he subcontracts out with wealthability, and I joined Sterling Rhino Capital this year. I'm really excited about being a lead financial advisor to the group and to the investors as well. And what I've seen in my practice is that a lot of people that are new to real estate or even been in real estate for a while really don't quite understand all the tax benefits or don't understand how those tax benefits apply to them, or how can they make changes in their tax landscape or in the way they invest to access those changes, access those tax benefits. So I like to do this little high-level educational piece on the different types of income that we have in the United States and how they're taxed. Because once you understand those different types of income, okay, you will understand how to use real estate to its fullest potential. The tax benefits, if leveraged properly, can take an 8% pref payment, okay, into a 25% rate of return, okay, every single year if you leverage the tax benefits correctly and you make changes and you have a strategic tax advisor that can reposition you so you can take advantage of the tax benefits the most beneficial way. So first, I like to point out there's three different types of income that we have in this country, the way it's taxed anyway. We have non-passive income. Non-passive income is your W-2 salary or your business or your regular trade of business, okay? That is something you participate in more than 500 hours a year and someone else does more work than you. We also have what's called passive income in this country. Passive income is the one we all want, right? That's the mailbox money. That's the check that shows up in the mailbox and you didn't do a whole lot for it. You just invested a piece of capital and you got a return on it and you spent not a lot of time doing so for it. So that's rental income by default in the tax code is passive. We also have other types of passive income like a passive trade or business. And that's something you spent less than 500 hours in and someone did more work than you. Okay, so it's the complete opposite of non-passive, right? Passive is different than non-passive. And then we have portfolio income. Portfolio income is your capital gains, your dividends, your interest. Okay, now these three buckets can, on its face, without any exceptions, can only offset each other. So a non-passive gain or non-passive income can only be offset by a non-passive loss. Same goes for passive income. Passive income can only be offset by a passive loss. Portfolio income, very similar. Capital gains can only be offset by capital losses. Okay, there are exceptions to these rules, but in its most basic form, that is how it works. It's like kind for like kind. Okay, you can make changes and you can access the tax code to change the way that works. But most people, when they start out, that's how it works. So the average person has a W-2 salary or a business, and they have an active stream of income or non-passive. Okay, then they get into real estate investing. And now they're hearing about this write-off and that write-off. And if they don't make any changes or they don't do anything differently, for the most part, the write-offs and the depreciation that come with real estate will literally just sit there on your tax return unused and will carry over for years to come. And it's literally, they're useless until made useful. So how do we access those benefits? Now, let me just flesh out those benefits really quickly for those of you who don't know, okay? When you buy a building, let's say the building is $1 million, okay? That $1 million can be written off over 39 years for multifamily real estate investments, okay? That's a long time. That's a very small deduction, okay? But when you involve cost segregation, it allows you to accelerate that depreciation. So if we accelerate that depreciation, a large chunk of it, somewhere between 20 to 30% of the building, will be accelerated into year one, into a giant paper loss for you. And it's so powerful because it's a paper loss. You didn't lose anything. It's the only loss really in business and in finance where you might lose money on your tax return, but you didn't actually lose anything. That's the key. That's what's so great about it. That's why, like President Trump, right? He makes full use of depreciation, makes full use of it, of course. So that bonus depreciation could be very large, very, very large. So you could have, we're involved with a property right now, and there's $700,000 of depreciation available. If you own 10% of that property, okay, that's like a $70,000 deduction. But if you're not set up right and you don't have the right pieces in place, that $70,000 is just going to sit on your tax return for years, So that's the main benefit of investing in real estate. Okay. Now, those write-offs can be used against rental income that you have coming in from your syndication. It can, but I can tell you right now, 70,000 will be more than enough to wipe out the rental income. So there's going to be leftover depreciation. Okay, that's the depreciation I'm talking about. So yes, a real estate investment will offset, okay, other rental income, but that's just using like one piece of your brain when it comes to real estate. That's a little piece. The big piece is using those bigger write-offs in a much bigger way. That's the main benefit of investing in real estate, is the bonus depreciation, those paper losses that really don't cost you anything. Yeah, they'll cost, you'll invest in a multifamily syndicate. It won't cost you anything because the syndicate is going to pay for your cost segregation study. They're going to pay for it. It's built into the operating expenses of the property. One of the other benefits that I like about real estate is the tax-free cash out refi, right? So if your property does a refi, and let's say you bought it for $3 million, and now the bank appraises it at $4 million, and your sponsors return to you, half your investment that you put in, okay? That's a tax-free distribution to you because it's debt. It's new debt, okay? And why is that key? Yes, you will have to pay taxes at some point down the road when you sell the building, but it's key because it frees up capital. Now you've got half your investment back and you still own what you originally put in for. So if I invest 125, if I invested 250 and I did a cash and my sponsors cashed out refi in year 2 and I got half of my money back, I still own the percentage that I originally invested that I was given for my contribution. But now I have an extra 125,000 that I can put to work, and we can worry about the taxes later. So it's almost a deferral of taxes, but it can work if you keep reinvesting. It's the velocity of money. You keep that money going. One of the other major benefits of tax benefits of real estate is the 1031 exchange. Okay, so it is possible that if you buy a piece of real estate, you can have a qualified intermediary shift the property into the qualified intermediary itself, and you will be able to kick the taxes down the road and shift that gain from that building into a new property. So you could take that capital gain that you sold that building for and roll it into another property completely tax-free. It's a major league benefit. Major league benefit. So then we get into the conversation of, okay, how do I get out of the purgatory, if you will? Purgatory is what I call when you have passive losses that are suspended and sitting there for years. That's purgatory for me because you can't use them and they're so powerful. Okay. How do you do that? Well, there's really two ways. Is one, to become a real estate professional. The real estate professional election is well known in real estate circle, but it's actually very unknown outside the real estate circle for people that are new to the business. So what does that mean? The real estate professional, remember I said that real estate income is by default passive? Well, if you become a real estate professional, now that income becomes non-passive and the losses become also non-passive. So now it becomes, since you're a real estate professional, it becomes your regular trade or business. It's just like any other business that you might own. So therefore, you get to use all the losses, no matter how it is, as a real estate professional. So look how amazing this is, right? If you're a real estate professional, and let's say like a guy like Paul, right? Paul, his wife is still working, right? Paul's wife is still working, and Paul is a real estate professional. And so what he gets to do is he gets to buy a building with leverage. He only puts in X amount of dollars. We borrow the rest, but you still get to depreciate the full value of the building, even though you only put in 200, right? So now Paul can use all of the losses from all his real estate and wipe out his wife's salary, and he can pay zero tax. As long as he keeps reinvesting, he can pay zero tax every single year. Because now we've converted a passive loss, okay, into a non-passive loss, and you can use that non-passive loss. That's like the trump card. That's like the ace in the deck, okay? That's the ace in the deck. It can wipe out capital gains. It can wipe out interest income. It can wipe out just about any income. It's the trump card. It's the ace, right? It can wipe out all that. So how do you become a real estate professional? How? So this is how. You need to spend at least 750 hours, okay, in a real estate qualified activity, okay? And what does that mean? That needs to be directly related to managing real property or transacting, putting people together to buy real property, okay? You can look up, Tax Advisor has a great article on all the different activities that qualify. Not everything qualifies. Just, standing around and going on realtor.com or Crexi or LoopNet, surfing around trying to find real estate, that doesn't count, okay? Does not count. So you have to become a real estate professional, 750 hours. Here's the key part. You cannot have more hours in another trade that's more than real estate. So if I put in 751 hours in real estate, but I do 752 hours in accounting, I'm not a real estate professional. I also say, if you have a full-time job, you've got little to no chance of becoming a real estate professional. The IRS has ruled in the past, if you have a full-time job, they don't care how many hours you spent in real estate, they will not consider you a real estate professional. Another tip, there has been court cases that said that they did view someone a little more favorably because they had a real estate license. The real estate license does help, okay? And you can get 120 hours for the education just to get the real estate license. So, real estate professional, you cannot have more hours in another trade. Like me, I can't qualify. I'm too busy as a CPA. Too busy. I can't qualify as a real estate professional. But my wife can. My wife can become a real estate professional. Once she leaves her W-2 job and she's sitting at home and, taking care of the family, she can become a real estate professional. And you can still access all the benefits. So it's not just you, it's your whole household that you're married to anyway. You can't have your kids be real estate professional because they're not on your tax return. So the real estate professional is one of the best ways to all of a sudden overnight, well, it's not overnight, you got to put in some time, 750 hours, take that passive loss and now make it an ordinary loss, and it will wipe out. It will do wonders, absolutely wonders. The other way to make use of the bonus depreciation is if you're a business owner. This is strictly for business owners now. Now, not everybody can take advantage of the real estate professional election. Not everybody can, okay? Maybe they need two people to work, husband and wife both need to work. Husband has a business that he just can't walk away from, okay? So what we do for clients is that they can't qualify for the real estate professional. And that might be a lot of our clients that come through Sterling Rhino Capital. That might be a lot of them because they're passively investing. So if you're passively investing, you're going to have a really hard time. The whole point of passive investing is so that you don't have to kill yourself being a landlord. You're not fixing toilet bowls at 2 a.m. in the morning, okay? You're passively investing in quality properties that actually make you money, okay? So if you're a passive investor in a syndication, there's a good chance you're not going to qualify as a real estate professional. There's a good chance. Very highly, actually, very highly likely. So then where do you go from there? Well, what we do for business owners is we help them carve out passive income streams. Because if we can carve out a passive income stream, now we can use the passive losses from real estate to wipe out that income stream. So we just did it in my firm because we're getting so much depreciation now from all this investing we're doing. We said, man, me and my business partner, Jeff, we are not eligible for real estate professionals. We clock too many hours as CPAs. So what are we going to do? Well, we carved out streams of income in our business where we have no involvement at all or very little. So for example, bookkeeping. My firm, we offer bookkeeping. I don't do any bookkeeping. I haven't done bookkeeping in 10 years, 5 years. Okay. My staff does it. I spend less than 500 hours in that activity, and my staff does more work than I do in that activity. Therefore, it's passive. So now we have our own bookkeeping company, and all the bookkeeping flows through there, and all the profit we make for that is passive income to me and my partner. And now I can use my real estate depreciation losses against that income. So all of our bookkeeping revenue essentially is tax-free every single year. We're actually taking it one step further because my business partner and I, we're doing so much consulting now, like I'm doing today. This is consulting. We're doing so much consulting that consulting is our non-passive everyday activity. I'm doing more time consulting people than I am preparing taxes. So now the tax prep and the bookkeeping is passive to me. So if I invest in enough real estate, the nuts and bolts of my tax firm will be completely tax-free to me. I just got to keep investing, because every year you're going to get a big write-off in that first year from the bonus depreciation. Then the write-offs will go down if you stop investing. I think a lot of people mess that up. I've had clients before, they took my advice. They're like, oh, this real estate stuff is great. I got my building. I'm going to get cost segregation, and it's going to give me write-offs for years and years and years. And then they realized after the first year, oh my goodness, my depreciation's gone. And I said, you got to keep investing. You got bonus depreciation. It's only for the first year. It's a big write-off. Sometimes that write-off is so big that it carries up. Let me make it clear. It's not use it or lose it. Okay. If you don't use it, it will carry over to future years. However, if you can use the depreciation, okay, and you use it all up, you got to keep investing. And I encourage all of you, if you go to sterlingrhinocapital.com and you sign up and you get access to the passive investment calculator, you can see how it snowballs year after year, okay? And the wealth that you can create and the income that you can create, okay? That calculator doesn't even take into effect the tax benefits. Okay, so one of the ways you can supercharge your rate of return. So let's say it's an 8% pref, right? Do the cash on cash calculation with the 8% pref, with the amount you invested. And then what I want you to do is add the tax savings to your income, the gross rental income. Add it in there as if it's more rental income. Okay, so do the cash on cash equation, but jack up the rent with the tax savings and see what your rate of return is. It will probably double, triple, depending on what tax bracket you're in, it will probably double to triple your rate of return. And if you do that every single year, okay, and the best thing you can do is those tax savings that you would have paid, Uncle Sam with, is put that into more properties and create more write-offs for yourself. Okay, so real estate investing is, it's a serial thing. It's like a, what do they call them? Serial entrepreneurs. Well, we're serial real estate investors because we're addicted to the write-offs and we're addicted to the returns and the snowballing of it. So those are two of the main ways to make real estate really work for you. The third way is doing good planning. If you're under $100,000. This is the one good thing. If you're a W-2 and you're sitting here and you're saying, oh man, you know what? I don't fall into any of those categories. I can't become a real estate professional. I can't carve out passive income stream because I'm not a business owner, or my business has no passive income streams because I'm just, I do one thing, right? So like financial advisors, that's a great one. I carve out passive income streams for them. But let's say you don't fall into those two categories and you're just a W-2 earner. You just, you work a good job, for instance, I have a client, she's a nurse. She makes about $90,000 a year as a nurse, and she wants to invest in real estate instead of her retirement plan. Okay. And she said, Al, you talk about all this different stuff, these real estate savings. Does any of it apply to me? Yes, it actually does. If your income is under $100,000, okay, you can get up to a $25,000 non-passive loss against your W-2 income. So if you're making 100 grand, okay, and you're making 100 grand, you will get 25. If you invest in a syndication, you can get up to $25,000 of tax deductions against your W-2 income. It's called the mom and pop exception. Okay. So now your income is 75,000. You're going to get a massive refund at tax time. Big refund at tax time. Okay. Now, if you make from 100 to 150, it starts to get phased out. So if you make $125, your write-off for real estate is only going to be $12,500. Okay. If you're over 150,000, you will not get the benefit of the real estate. So if you're a W-2 owner over 150,000 and that's all that you do, the write-offs it really might be tough. I'm going to be honest. It might be tough for you to really take advantage of it. Now, that doesn't mean that does not mean that the real estate doesn't benefit you. It does, because think about it. Think about it this way. This is another tax benefit of it. Okay. If you do the passive income calculator, right? You take the passive income calculator and you have fun with it, right? I love playing with it. I like going, all right, how rich can I get, right? And I go 30 years. 30 years, I'm going to do $50,000 a year. I'm going to start with 250, and I'm going to get up and I'm going to have $150,000 a month coming in retirement. Okay. Now, if I do that calculation in the calculator and you compare it to the IRA, right? That, let's say in 30 years, I'm getting $150,000 a month in rental income. Okay. Now, if you are in retirement and you're getting $150,000 a month from real estate, you will probably pay very little income tax on that real estate because you haven't used your depreciation to its fullest, and it will keep building. Okay. It will keep building. And in retirement, if you've invested enough, that income will be tax-free for you, as opposed to an IRA that you're going to have to pay ordinary income tax on. So if you do the calculator and you see, wow, I'm getting $150,000 a month versus $50,000 a month in the IRA, remember, that IRA is taxable. So the gap is even bigger between the real estate income and the IRA. It's huge. The other thing that will benefit you if you're a W-2 person is in the year that you sell the property. So those suspended losses, let's say you're not using them, right? Let's say you're not using them. The year that you sell the property, those losses actually become non-passive and you will be able to use them. And they will help you in that year of sale that you are about to take a capital gain on. So that's a big benefit. So if you're going to sell your property in 5 years, okay, if you're going to sell your property in 5 years and you're not using depreciation because you're just a W-2 guy, making 180, here in New Jersey, people make 250 on a W-2 without a blink of an eye. Okay. And if that is the case, when you sell the property, that suspended passive losses will be able to be used. So it's not, there really is tax benefits for everyone, just at different times. Okay. The business owners, the passive loss guys, the real estate professionals, they will be taking it more up front. The W-2 people will be taking it on the back end. So understanding these concepts are crucial. I recommend you talk to a tax advisor that's savvy with real estate, understands the principles, has actually looked at a cost seg study before. You really talk to somebody who understands real estate, because a lot of CPAs in my business don't. Okay, they claim they do, but they really don't. It's a very complicated area of taxation. It's something that you need to be doing every day and talking about. So we got a bunch of questions here. Eddie Trumbull, you're saying AGI, what's that called again? So that's adjusted gross income. What are you referring to, Eddie? Is that AGI? What do you mean?
He's asking whether or not that threshold, that $100,000 or less, is that adjusted gross income? And what was it called? I think you said mom and pop.
Yep. So the mom and pop deduction, mom and pop exception, okay, that is based on AGI. Yes. Yes, it is based on AGI. Good catch there. It is based on AGI. So let's talk about AGI. A lot of people are not that familiar with what AGI is, and let's talk about how to get below 100,000 with your AGI. So if we look at a tax return, pulling up a 1040 right now. They keep changing the tax returns, so this most recent rendition is terrible. So if you look at a 1040, okay, adjusted gross income is line 8B. That means it's your total gross income, capital gains, W-2, IRA distributions, pensions, Social Security, capital gain, whatever, minus your adjustments. Your adjustments could be retirement contributions. So if you're a W-2 worker and you're maxing out the 401k at work, that will reduce. Yeah, that's an adjustment. Retirement contributions are probably the most common adjustment down to AGI. Now, your taxable income is after you deduct your itemized deductions like mortgage interest, property taxes, and that stuff. That gets you your taxable income. The mom and pop exception is based on AGI. So on your tax return, line 8B will give you your adjusted gross income, and that will tell you if you can take advantage of the mom and pop. We got another question. Many passive investors use a self-directed IRA to invest in real estate. Do they benefit from the bonus depreciation loss? I'll answer the first question. The answer to that question is no. When you invest in an IRA, you essentially lose all of the tax benefits of real estate, sort of. Now, that is a sort of, because if you sell the property, okay, you can sell it capital gain free. So you don't have to worry about a 1031 exchange. And then you can keep investing in other properties. So I'm glad you asked that question, because for people that are in a W-2, it might be a great idea to do it in the self-directed IRA. Okay? Because your benefit on the taxes is not as great as those who are business owners. It's not as great. So maybe the self-directed IRA, maybe you don't care about the tax benefits. You care about the tax benefits on the sale and not having to worry about the IRA, not having to worry about a 1031. 1031s can be a pain in the neck. They make things very difficult. So the IRA, there's definitely a place for this stuff in IRAs. Not as juicy with the tax benefits, but on the back end, the sale is pretty good. You don't have to worry about a 1031. So I like that. Also, doesn't the bonus depreciation that you take in year one also resets the basis in the property so that your capital gains will be based on the adjusted basis? So really the tax benefit is more of a time value of money issue. That's a great point. So one of the reasons why you want to take the bonus depreciation in year one is because a deduction today is better than a deduction tomorrow, right? So if you get bonus depreciation, you get 20% of the bill, 20 to 30% of the building accelerated and get that up front instead of spreading it out over 39 years, right? So 39 years, okay, a dollar to in 39 years is going to be worthless. So yes, it is a time value of money issue. When you sell the property, yes, you will have to get what's called a Section 1250 gain, which will be paying back the depreciation. Okay, paying back the depreciation at a 25% rate. It's called a Section 1250 gain. But really what you want to do is you really want a 1031 if you can. If you cannot, yes, you will have to pay taxes. The next question, he's saying, does UBIT impact self-directed IRAs when used in a syndication? That's a great question. So UBIT is unrelated business tax, okay? I would have to actually, to be honest with you, I can't answer that question. I would have to get back to you on that. I do not honestly deal with, most of my investors do not deal with an IRA. Unrelated business income tax, not an area that I'm an expert on, to be honest.
Hey, Al, let me chime in. Let me chime in
Yep.
for a second, if you don't mind. So I actually have a lot of my retirement account converted over to a solo 401k. And in that case, I did some pretty extensive research with some real estate attorneys early on when we were building up Sterling Rhino Capital. And in that case, I am not subject to any sort of UBIT or any sort of tax penalties as long as those funds stay closed loop. Now, we researched it pretty extensively, and there are issues if you're an employee or an employer and you're in the wrong type of converted fund, if you will. So you take your IRA funds and you convert them to, let's say, for example, a solo 401k, and you're an employee instead of going into a qualified retirement plan, right, where it's not set up appropriately, you could be subject. Or if you, let's say, pulled money out and invested it in the wrong asset, like a single family vacation home versus a multifamily asset, there are things that can jam you up if you're not careful, which is why it's really important. Al's point is to, consult a qualified real estate attorney that understands all this stuff and also understands the accounting piece. Because if you just go talk to a CPA, they may not really truly understand what you're trying to do, and you can get hit with some pretty stiff penalties. It's kind of like during this COVID process, there's lots of things that you can do actually with your IRAs that you wouldn't normally be able to do. And if you're not well versed, you won't be able to take advantage of those things. So for me, I'm in a solo 401k. I have other investors in Sterling Rhino that are in qualified retirement plans, solo 401ks, and other types of funds. But it has to be specific to your situation so that you can avoid any of those penalties. So we can give advice, but again, I'm not a CPA. I just know what I've set up.
From what I understand, self-directed IRAs are subject to UBIT if there's debt on the property. So I know the debt comes into play there. However, for solo 401ks or the QRP, a qualified retirement plan, are not. That's one of the advantages to moving your money over to one of those.
Yeah. And for me, being an independent contractor, multi-business owner, it was easier and it made more sense for me to set up a solo 401k versus a QRP, right? So there's all these advantages and these little loopholes and little opportunities for whether it's an employee, an employer, or an independent contractor to take full advantage. But you have to consult a CPA and give them your specific circumstances to figure out which way you can best set that up. One of the things you mentioned earlier, Al, I just want to touch on before we close here, is you talked about the cost segregation study, and I wanted to give you guys a quick example on how that works. So we just closed on a property and we had a cost seg done, and let's just give you an example of, let's say, a $2.1 million raise. Okay, so you do this cost segregation study, and they come in and break everything down. And you end up with, at least in this case, about a 67% advantage. So what I mean by that is if you were to take the 2.1 million and then take the cost seg study against it, in this case was about a 67% advantage. So how does that work? Well, they cram a lot of it up into the first year. So there was about a $900,000 write-off, if you will, advantage in year one if you wanted to utilize that against the 2.1 that was initially invested by everybody. And so what happens is when you divide that 900,000 against everybody's investment and the cash flow they're all taking the first year, it's gigantic, which is what Al was saying, right? So if you, for example, got a $40,000 write-off and your cash flow was only 12, well, you have this extra difference between the 12 and the 40 that you can either push down the road and utilize or take it against those other earned incomes, if you will. So that's how this cost seg kind of thing works. And oftentimes I'm asked when they start, well, what's my advantage? And you don't really know until you do a cost seg because they're slightly different. get a pretty good idea. It seems to be somewhere in that 65 to 80% range, depending on the asset class. Mobile home parks and multifamily are different. So depending on your investment, that's what will dictate how advantageous that cost seg study is. But it is massive. And in my case personally, I'm invested in 2,300 doors across the country. We own hundreds of doors as a team as well on our own. And I have single families, duplexes, and all of that. And last year I got a huge check from the IRS, which was phenomenal, right? And this year, if I want, I'll probably get the same, but I'll probably push it down and use it in other years because there's going to be a huge advantage. I think I have like 9 K1s coming back this year, which is substantial. So we just encourage you guys and gals to educate yourselves and just really truly understand the advantages and talk with people in your circle of influence about what they're doing, because you might learn from them or drive them to that calculator so they can play in it as well. And they might have a circumstance where they can take full advantage of that cost seg study and get involved in this space. Because the thing is, most people just aren't exposed to all these advantages. They have no clue it exists. And if you're talking to your own CPA or financial advisor, it's a good chance they don't know either, because they're not an expert like Al, who actually lives in this space all the time. So we really appreciate your time today, guys. One thing that Al offered up, which is really cool, is a 30-minute consult with him. No commitment. Just if you really want to dive in a little bit more to your situation and learn more, you can email him at al@sterlingrhinocapital.com and set up a call with him, and he'll deep dive into your situation and give you some advice on how you can better utilize those tax advantages. And if you haven't yet, you can download that calculator on our website, sterlingrhinocapital.com, and you just get into our funnel where we send you all kinds of great educational stuff. You feel free to opt out, but we also encourage you to go to our YouTube channel and subscribe and check out all of those videos, because we're doing short videos about all these topics that can educate you as well. And we just want to help you get to an early retirement and pay no taxes if we can. That is the ultimate goal. Everyone here wants financial freedom and wants to kick that tax can down the road if possible, and that's our ultimate goal. So if you have anything, Paul or Al, please chime in, and if you don't, we will exit the call and look forward to your future.
I just want to highlight that I think Al said that I'm not going to pay any taxes next year. So this is fantastic.
Yeah.
I'm super excited.
Yeah, I mean,
I love that.
Paul is set up right. Paul is set up right. He's got the right combo, wife working,
Yeah.
Real estate professional. He's going to have the right hours. He's going to have it logged. He's going to have it, buttoned up. Listen, the real estate professional, think about how powerful it is. Don't you think the IRS is probably going to look hard at it, right? So if you're going to go on a limb to claim that status, you better have your ducks in a row, done right, have your time logged correctly. Real estate license helps, not required, but it helps. And absolutely. And also, I think maybe what we should do is have another segment of real estate investing via retirement vehicles. We could spend an entire hour on that. If that's what the audience wants. I'll be honest with you. A lot of my clients are business owners. They would never put a real estate in an IRA. Okay, they would never. It's really not an area I'm a specialist in. I will, if that's what the people want, because it does work for. I see how it could work for people. I definitely could. If you're not a huge business owner, or you're just a W2, I could totally see how that could work for you. Me, I want the tax benefits all the time. So yeah, but I think we should maybe do a segment on. And if you guys in the audience really want that, let us know. We will do a segment on that.
Cool. Thanks, Al. Hey, we appreciate all your time. We hope this has been educational. Please reach out to any of us, Paul, Al, or myself, if you have any questions. And we'll look forward to seeing you guys next time. Chris with Sterling Rhino Capital. Have a great night, guys.
Take care, everyone.
Good night, everyone.